What's up everybody, it's Agwu here, and today we're diving into a topic that's absolutely crucial for any aspiring Forex trader: liquidity. Now you might be thinking that liquidity sounds kind of boring, but trust me on this. One, understanding liquidity can make or break your trading success. See, liquidity in Forex basically tells you how easily you can buy or sell a currency pair without causing huge price swings. Imagine trying to sell a rare comic book versus selling a popular video game. One is going to be a lot easier to offload quickly at a fair price. Same goes for currencies. So in this video, we're breaking down the key indicators you need to measure liquidity like a pro, so you can trade with confidence and avoid getting stuck with bad trades. Let's get started. The first thing you want to look at when assessing liquidity is the bid-ask spread. Now, this spread is simply the difference between the price someone is willing to buy a currency pair for, the bid, and the price someone is willing to sell it for, the ask. Think of it like this: the smaller the spread, the more liquid the currency pair. A tight spread means there are plenty of buyers and sellers ready to jump in, so you can usually execute trades quickly and without much price movement. Take EUR/USD for example. This pair is super popular, so it usually has a tiny spread, sometimes even a fraction of a pip. That's a sign of high liquidity, meaning you can buy or sell large amounts without moving the price too much. Next up, we've got trading volume. This one's pretty straightforward. It's simply the total amount of a currency pair that's been traded within a specific time frame. Higher trading volume generally indicates more liquidity. It means there's a lot of action happening, with plenty of buyers and sellers participating in the market. Remember, we want to be where the action is. Now, unlike the stock market, the Forex market is decentralized, meaning there's no central exchange tracking all the trades. But don't worry, most brokers and charting platforms will provide you with volume data based on their own network of traders, which is still a good indicator to watch. Now let's talk about market depth. This one's a bit more advanced, but stick with me. Market depth shows you the number of buy and sell orders that are waiting to be filled at different price levels. Imagine it like a peek behind the curtain. A deep market means there are tons of orders stacked up on both the buy and sell sides across a range of prices. This is a sign of high liquidity because it means the market can absorb large orders without causing drastic price fluctuations. Think of it like a busy restaurant versus an empty one. If a big group walks into a packed restaurant, they can probably squeeze in somewhere. But if that same group walks into an empty restaurant, it's going to be a lot more noticeable. Same idea with market depth. Now, let's talk about the relationship between volatility and liquidity. Generally speaking, high liquidity tends to go hand in hand with low volatility. Think about it logically. If a currency pair is super liquid, with tons of buyers and sellers ready to trade, it's going to take a massive order to move the price significantly. That means the price will generally be more stable. On the flip side, when liquidity dries up, things can get a bit wild. During low liquidity periods like holidays or off-hours trading, even small orders can cause big price swings. That's why it's crucial to be aware of these periods and adjust your trading strategy accordingly. Chapter 5. Session liquidity, riding the waves of the market. Now here's something crucial to remember. Liquidity isn't constant throughout the day. It actually fluctuates depending on the trading session. The Forex market is a 24/5 beast with major trading hubs in London, New York, and Asia. When these sessions overlap, liquidity is usually at its peak. For example, the London-New York overlap is prime time for Forex trading with tons of volume and tight spreads. That's because you've got traders from both sides of the pond actively participating in the market. So if you're looking for the most liquid trading conditions, it's generally best to stick to the major session overlaps. Chapter 6. Slippage levels. When your trade doesn't go as planned. Now let's talk about slippage. This is something you definitely want to avoid as much as possible. Slippage is the difference between the price you expect to get on a trade and the price you actually get filled at. Imagine you're placing a market order to buy a currency pair at $1.20, but because of low liquidity, the order gets filled at $1.21 instead. That one pip difference is slippage, and it can eat into your profits over time. Frequent or large slippage is a telltale sign of low liquidity. It means there weren't enough orders available at your desired price, so your order had to slip through to the next available price level. Chapter 7: Currency Pair Characteristics. Not all pairs are created equal. Finally, let's talk about the inherent liquidity of different currency pairs. Not all pairs are created equal. Major pairs like EUR-USD, USD-JPY, and GBP-USD are the most heavily traded pairs in the world. They're like the blue-chip stocks of the Forex market. These pairs typically have the highest liquidity with tight spreads and plenty of trading volume. On the other hand, exotic pairs like USD-TRY or USD-ZAR are much less traded. They're like the penny stocks of the Forex world. These pairs often have wider spreads, higher volatility, and a greater risk of slippage, especially during low liquidity periods. Outro trading smart, using liquidity to your advantage. So there you have it, a crash course on measuring liquidity in the Forex market. By keeping an eye on these key indicators, you'll be way ahead of the game when it comes to making informed trading decisions. Remember, liquidity is all about understanding how easily you can buy or sell a currency pair without causing major price disruptions. High liquidity is your friend. It generally means tighter spreads, lower volatility, and less risk of slippage. So do your research, choose your trading times wisely, and always be aware of the liquidity conditions before you hit that buy or sell button. Stay informed, trade wisely, and I'll see you in the next video.